This video is the first of a two-part series where we're going to look at the idea of a non-interest bearing note. So essentially a note issued at a discount. And as you know, there's no such thing as a free lunch. And what they mean there too is there's no such thing as free money. So if someone says to you, oh, I'm going to lend you $10,000 and there's no interest, and you just pay me back $10,000. Well, they're not going to give you $10,000 cash. They're going to give you less than $10,000, and you're going to pay back the whole 10. The difference would be the interest. Now, in a similar way, let's look at this first example. And the first video here, we're looking at a non-interest bearing note, same idea as a discounted note, but there are no periodic payments. So in this case, we have a 2-year note, and we're not going to get any money in the first year. They're going to pay back the whole $700,000 in year 2. Now, our equipment sale here, it says we sold equipment. Well, the sale is not $700,000. The sale is the discounted value of this note. So once again, we're going to be using the financial calculator, and we're given a market rate of 8%. So part of that $700,000 is a sale of equipment, and part of it is the interest that we're going to earn over the next 2 years. So why don't you see if you can calculate the present value of this note? So you might want to just pause the video and go ahead and calculate this on your own. The more you can do on your own, the easier your practice will be and the better off you're going to be when you go to do your final exam. Okay, so I'm guessing you did this. What we have is a period of 2 years, so N is going to be 2. We're going to receive $700,000 in the future. Our interest rate is 8, and there are no payments. So essentially we just need to calculate the present value. So remember, if you were not able to get this number exactly, remember to clear your calculator, and if you key in 700,000, hit the future value key, 8, hit the I per year key, 2, hit N, and just in case if you wish, 0 for payment, and you hit your PV key, you will get this number. Okay, so that's the amount of the note, and we're going to take the 600,000 and change, and we're going to add interest over a 2-year period at 8%, and we're going to receive 700,000. So in fact, this 600,000 is the amount of our sale. So let's go ahead and record that. So here is December 31, year 5. Here's the note, and here's our sale. Now, of course, somewhere back in here, we would have a cost of goods sold entry, but that's not what we're trying to figure out. So we'll just leave it at sales. So this is essentially the beginning principle of our note. So the next thing we need to do, and you notice this was a December 31, year 5 sale. You stayed up late at work on New Year's Eve and sold some equipment. Yay. Well, what it means is you don't have to do an adjusting journal entry at the end of year 6. That's what that means. So, you do have to do an adjustment, but it's a full year. So pretty nice. Let's look at that. Here is our principal amount times 8%, which is our yearly rate. Now you'll notice that, as you would expect, there's a credit to interest revenue. So, when you do this calculation, you'll get the 48,000, and there's a credit to interest revenue. However, this is not a debit to interest receivable. Our note needs to be at a carrying value, essentially 700,000, when our customer pays us in 2 years' time. So instead of debiting interest receivable, which is what you would do for a standard interest-bearing note, we're going to debit the note itself, and you'll notice that our note was 600,000. We just added 48. Now we're at 648,000 and change. So at the end of year 6, this is the carrying value of our note. Now, one more year of interest down here, look at this. 648 times 8% is the remaining interest to be earned. Now, this is off only 1 penny, right? Not bad. So if I take the 700,000 face value that we're going to get in a year, subtract the carrying value, I should get the remaining interest. And this is just to prove that we did. And a 1 penny rounding error is fine. So at the end of the second year, we're going to get our $700,000. We're also going to have interest revenue. And the customer is paying off the note. So let's look at that journal entry. And what I would like you to recall from this is that if a note is a 0 interest note and it has no payments, we have to move that book value from the present value up to the future value. So we're just going to keep adding to the note, and then we get our money. So here's us getting our money. Here's interest revenue for the second year, and this was the carrying value of the note. Now you could have done this in 2 journal entries. You notice this is 648, 148. You could have done this entry for the next year's interest. Remember, I'll just switch over here. That was 51.8. You could have done another journal entry just for the interest. That would have brought the note up to 700,000, and then you could have just taken your cash debit, note credit, 700. So this is a combined journal entry that did both of those things at the same time. But either one would work fine. Okay, so that's an example of a discounted note with no payments.